Right now, we are in the worst bond market we have seen in decades. And this has caused a lot of retirees to leave bonds for other safe alternatives. And there certainly are a lot of safe alternatives that you can use outside of bonds. But in this video today, I'm going to show you how you can make bonds safe once again for your retirement. But in doing so, you need to first understand some important dynamics around bonds. So when we purchase a bond, let's say that has a maturity 5 years from now, we expect to invest a sum of money, let's say $10,000 into that bond. And then by the time we reach that maturity with the interest that we've earned, we have more money from that given investment. But the problem is there are some variables that can affect the value in the interim. So as interest rates either rise or fall, the value of our bond can change before the time that we reach that maturity. Now, ultimately, this will revert to that given amount that we ultimately receive if we hold to maturity. But the amount in the interim can vary quite a bit. And so as interest rates have been rising, we've seen this exact issue with bonds. On the screen, I have a bond target date fund year to date that is down 10%. Now, many investors flock into bonds for safety, knowing they won't experience the same volatility that we'll see in stock market performance. But as you can see so far this year, we haven't really seen bonds be that given safe haven. We've been spoiled over the last 40 years as interest rates have been steadily dropping, but now as interest rates start to rise, there's a lot of risk in bonds. For instance, for every 1% rise in interest rates, the longer duration bond that we hold, the more risk that we take. On the screen, you can see that if we hold a 30-year bond, every 1% rise in interest rates will cause that bond to lose 18%. On the flip side, the shorter duration, let's say a 2-year bond, will only lose around 1.2% for every 1% rise in interest rates. But no, as interest rates are rising, there ends up being a lot of risk in bonds. This is specifically the case within bond funds. So if you purchase an individual bond and you hold that bond to maturity, you can overcome that interest rate risk. Yes, there may be some volatility in the interim, but understand that if you hold to maturity, you will eliminate that interest rate risk ultimately. The problem with holding a bond fund, as many investors do, is that there are a bunch of different bonds that are constantly being added to that fund. We can't always guarantee things are held to maturity. There's a lot of trading going on in the interim. And so at times that manager might be locking in bond losses and thus causing that bond fund to lose quite significantly. This becomes very difficult then to invest in a given bond fund. Now, the alternative is holding a lot of individual bonds, but that represents its own set of risks. Because, for instance, when we purchase a given bond, how do we know what is the best bond to purchase? All of a sudden, now we need to develop a diversified basket of individual bonds. On top of that, there can be liquidity constraints within individual bonds. So we may be buying bonds at a haircut, thus already guaranteeing a loss within those bonds relative to what we could have earned if we would have had better liquidity or better ability to enter those individual bonds. Now, if you've watched our videos before, you'll know that I'm not a huge fan of most target date funds. But there is a recent innovation within the bond space that creates a target date fund for bonds that I think can be quite attractive as opposed to other bond funds. Now, I'll link to this website in the description below. Know that iShares as well as Invesco both have these type of bond funds. But essentially why these bond funds can be a bit more attractive is they can overcome interest rate risk. So they have ETFs in categories from treasury all the way to high yield. And essentially what these funds are is they have a targeted maturity, meaning they will hold a diversified basket of bonds within that given fund, all with the same or similar maturity. So if you hold that given fund to maturity, then you can gain that expected yield. Now, as you can see, this is a map showing in the treasury sub-asset class all of these different targeted maturities. Let's take something like IBTD. This would be a 2023 targeted treasury ETF. Now, note that this is named the iShares iBonds 2023 term treasury ETF. This does not hold iBonds, but rather is just a name that iShares calls their given ETFs, which can be quite confusing, I understand. But as you can see here, the weighted average yield to maturity is 2.94%. So if we dig into this given bond fund, you can see that it has a expense ratio of 0.07%, and understand that you may still lose money, at least on paper, in the interim as interest rates rise and fall. But if you hold to that targeted maturity, we will rise to that given par value and you will receive the given interest rate. So the yield to maturity is really what you want to focus on here. And what you'll see as we start to go further and further down into the portfolio characteristics, you can see that this specific ETF holds about 20 different treasury bonds. and has again, average yield to maturity of 2.94% with the average maturity in about a year. Now, if we go back to this ladder tool and understand that you could start to use this to build a bond ladder for your retirement without having to own individual bonds. You can own a bond fund. But we can see there are different sub-asset classes that we can choose from. Everything from muni bonds, where we will earn a little bit more of a tax-efficient yield, corporate bonds, where we should earn a little bit higher yield because we're taking a little bit more default risk. We're taking more risk within those bonds that we're ultimately holding, all the way to high yield, you'll see has the highest overall yield. Now understand that if you hold to maturity, you will be eliminating the interest rate risk in the interim, but you may still have default risk. And so what you'll see here, when we start looking at the high yield funds, we'll see much higher yields to maturity. We'll see different average maturities based on the term that we're holding to. Understand that you may not receive this exact yield if we start to see some default risk within this given fund. So with high yield, the reason that you earn a little bit higher yield is because there's the potential that some of those bonds end up defaulting. But nonetheless, by using a target date bond fund, we can at least have a backstop where we know that if we do see interest rates rise and thus the bonds lose money, at least on paper, we have that backstop where we can hold those given bonds to that given term. Now, on the flip side, if we see interest rates fall back down, there may be additional opportunities to take liquidity off the table even sooner. And there is a general consensus that this risk of interest rates continuing to rise isn't going to be something that is eliminated anytime soon. The Federal Reserve has been on a path that as we continue to see higher and higher inflation, they're planning on raising interest rates to try to decrease that given inflation. And so there is a general consensus that we expect to see higher rates towards the end of this year across the globe. And so this is a risk that is going to be top of mind for a lot of investors, and understanding that there are still ways that you can invest in bonds in a safe way. And so the message here is, yes, there is still some risk, in my opinion, in bonds moving forward, but you can sidestep some of that risk by investing in bonds in more alternative ways. Now, as we start to enter a new regime, we need to go outside of bonds. In fact, in this video right here, we talk about how you can start to build a better portfolio for shorter term income needs. Now, this is a fairly math heavy video, and this will dive into maybe some investments that you're not as familiar with, but nonetheless, you can start to see that as we start to build a more rounded portfolio outside of just bonds, we can start to earn higher yields and provide more safety to our retirement.